When I first started investing over 20 years ago, I really didn't know a whole lot. Yes, I had my mom who was an investor and my grandma who were investors, and yes, they knew a little bit about the stock market, but they had stockbrokers. I mean, this was a different time. It was the 80s, it was the 90s. This wasn't like today when you can just go open an account with Schwab or Robinhood or Fidelity or whatever and just start doing your own investments. So, as someone who's now been investing for over 20 years, knowing what I know now, what would I have done differently? What mistakes, what errors, what would I have changed with my investments when I was in my early 20s? Well, let's talk about it. If you're new here, welcome back to my channel. My name is Kenneth Suna, and I teach my 500,000 social media followers how to trade, invest, and simplify their lives. And I always said simplify in terms of minimalism, but one time someone DM'd me and they were like, I love the way you simplify all these complex investing and trading strategies. And I was like, oh, simplify. Another use for that name. I make this stuff, I simplify it, make it easier to understand. This is also, by the way, why I have this channel, because when I first started investing 20 years ago, this didn't exist. There was no place to interact. And as it became more prevalent and more popular on social media to be able to talk to an investor, of course, people started popping up saying, buy my thing, buy my course, buy my guide, pay for a one-on-one. I don't do any of that, by the way. Everything here is 100% free that I offer, especially on my website, which I'll put a little photo of right around here. Now, let's talk about what I would have done differently. So for those who know me and for those who don't, I wanted to be a professional wrestler when I was 18. And I was lucky enough that my mom was cool with it, terrified, but still cool with it, and was like, hey, you're only young once, go for it. So I'll leave a lot out, but I got thrown over the top rope on the first day, hit the cement, broke my back, and came home with no real plan. And my mom was like, well, you can go to college. And I was like, nah, I don't want to go just to go. So when my back was all healed, I started working in the restaurant industry. I was working double shifts. I was making a lot of money. And one of the great stories, even before that, going even further back to high school, was when I graduated high school, I got an Apple laptop as a gift. And it was so great. And all my friends got Apple gifts, iTunes gift cards. The iPhone hadn't come out yet, but the iPod was out and everyone had the iPod. And I was like, and I was kind of noticing a trend here. And I said, oh, let me get on the phone with that stockbroker. And I said I wanted to buy stock in Apple. And he was like, oh, don't waste your money on Apple. Nobody wants to listen to music on a computer. So from the jump, I was getting bad financial advice from experts, from professionals, from licensed financial advisors, stockbrokers. Another little bit of bad advice that I got came a couple years into my career in the restaurant industry. I would be an expediter in the morning, so the line cooks would make the food and they'd put it up in the window, and I would take it and I would put the lettuce and the guacamole and the sour cream and cheese, and if it was fajitas, I'd get the tortillas and rice and beans, and I'd set up all that stuff. I'd put it on the tray and I'd say, runner, and someone would come in and get it, or I'd carry the tray out to the table myself and hand out, serve all the food. In the evening, I was a line cook. So I made more money as a line cook, but I was working these incredibly long days where I would have like an hour break in between expediting and line cooking. And I'd go to the gym, I'd work out, I'd come back, and I'd begin my shift, my dinner shift. So I was working these incredibly long shifts, and I was making a lot of money. And added benefit for me, I was living at home, which, yeah, it kind of sucks when you're in your early 20s. You don't get to have your own place, you don't get to decorate it and whatever. But I was saving a ton of money. It was all, unfortunately, going into my high yield savings account, which, yeah, high yield, great. I was making a little bit of money, but I could have been making a whole lot more. If only a platform like this had existed back then that I could have watched and learned from. And at some point, I don't remember how or when or where, but at some point I heard someone say, hey, you should open a Roth IRA. I didn't know anything about it. So again, we had a family friend who was in finance, and I said, hey, can I call this guy and ask him? And I get on the phone with this guy and I said, hey, I'm like early 20s, like 23, 24. I'm making all this money. It's all going into savings. And I read something about a Roth IRA. Should I open one? And he said, nah, don't worry about it. It's not worth your time. And I said, well, this guy is a professional. And I had gotten 2 bits of advice from professionals that really screwed me over the long run. Now, yeah, the Roth IRA contribution has increased. So it's $7,000 now. It was closer to $5,000 back then. But if that was my standalone investment, one S&P 500 index fund, Well, I'll put the graphics right up here on the screen. I could have maxed it out at the beginning of the year, every single year, $5,000 into SPLG, and just taken it extremely easily. And you can see I'm 39 now, where that money would be today. Oops. But I listened to the professionals. And it's not to say that professionals are 100% wrong 100% of the time, but I'm more, I want it to start and end with me. I don't want to be putting the blame on someone else. It should be my fault that I did this thing or didn't do this thing, not some financial advisors. I want kind of like the buck to stop with me. I should have opened that Roth IRA. I should have bought stock in Apple. I should have researched these things and made my own decisions for what was best for me, not what some professional had to say. I still don't really know why this guy had said that the Roth IRA was a huge waste of time and that I shouldn't open one. It would have been a humongous tax savings for me. And if I had kept that $5,000 consistently, even though it's closer to $7,000 now, I could have put me on the path to a much earlier retirement. And I never did that. Another huge mistake that I made was listening to strangers. So yeah, I listened to the professionals and they gave me bad advice, and I listened to the strangers and they gave me bad advice, which is why, again, I want all of this stuff to kind of start and stop with you. This is why people say, like, can I copy your trades? Can I copy your investments? And I always say, no, there's nothing really for you to that doesn't teach you anything. It makes you dependent on me, which I don't want. I don't want someone going, okay, what did you buy today? What are you buying now? Should I sell this? I bought it when you bought it. Or when do you sell it? Can you tell me? It's too much management. Like, I had this one guy say, like, hey, when you sell the stock, could you tell me? And I was like, man, I've got 300,000 TikTok followers. You think I can remember you out of all 300,000? Oh, in 15 years, when I sell the stock, I have to write Dylan and say I did it. No, come on. Like, let's think about this for a second here. You want to be responsible for your own investments and your own strategies. Don't necessarily rely 100% on the experts. Don't rely on the strangers. If someone tells you something, someone gives you a tip, go and research it. I didn't do that. That was a humongous mistake. The third and final mistake that I made was listening to strangers at my gym, which is the equivalent to listening to strangers on TikTok today. There was this guy who comes in, he swings open the door one day, and he's a regular in the gym, and he's always talking about stocks. And he kicks open the door and he goes, do you like soda? And I was like, yes, I like soda. And he was like, well, there's a new soda company in town, and they have the premier spot in the grocery store. You know, you can walk the aisles, and like eye level is the best. You don't want to be on the bottom. You don't want to be out of sight. But the end unit, like when you go between aisles, that display in the center, that is premier real estate for any company. And this soda company has that at the Giant up the street. And I was like, oh my God, so what? One Giant up the street, who cares? And he was like, they are going to put Coke and Pepsi out of business. They're big, they're new, they use organic cane sugar, they don't use corn syrups and shit like that. And I was like, oh my God, the more he was talking, the more excited I was getting. Now, I was making minimum wage. At this point, I was out of the restaurant. I was working at the gym. I was working front desk, beep, have a good workout, beep, have a good workout. And I was like, man, I don't want to do this forever. I didn't know what I wanted to do. All I thought was, all I need is to be rich. If I can become rich, I can buy time to figure out what I want to do with my life. So this guy's telling me this soda company is going to put everyone out of business. I listened. I didn't research. I didn't know anything about speculative investments. I didn't know anything about earnings and revenue and to look at these things and read analyst reports. All I knew is I had a lot of money and it was sitting in a savings account. So I went home, and I think it was around $16 a share. It's called Jones Soda. It was $16 a share, and I bought $10,000 worth of the stock. And it started dropping. And I started to get kind of nervous. And I found this guy at the gym, and I said, hey, what's going on here? And he goes, oh, it's a great opportunity to average down. Averaging down can be okay sometimes, but on a high risk stock like this, it's just throwing good money away. But I listened, and I bought another $6,000. So I put 16 grand in total. And I have a 99% loss in this company today. It's still in my portfolio. On years when I have really good, when I make a lot of money, I'll sell off my losers to bring down some of my taxable income. So I'll use it at some point to bring down what I owe. But, it stings. And I could have put that money into an S&P 500 index fund. I could have put it in a high quality tech ETF, something that would have had lots of years of growth. And I missed out on because I thought, oh yeah, I'll put all my money into this penny stock. One unrelated, but it just reminded me. There was a period after all these years in the restaurant where I had a lot of money saved up. I had around $90,000 sitting in my bank account. And a studio apartment came up for sale in my mom's building. And I called a realtor family friend that we know, and I said, hey, can you come look at this property for me? I'm thinking about buying it as an income property. And he came in and he said, oh, God, $90,000 for a studio, and the condo fees and property tax, and you're gonna have to paint it, and you're gonna have to renovate it. He was like, you're never gonna sell this for more than you paid. Ever. You're never gonna sell this for more than you paid. We're at the all-time highs in the real estate market. This was like 2006, 2007. He was like, you're never gonna get this money back. And the taxes and the condo fees, that's going to eat into your profit. I would pass on this. Well, about 15 years later, studios in that building were going for around $200,000. And the rent had steadily increased all those years as well. So, I kept listening to these professionals and it kept biting me. And I listened to idiots and it would bite me. So the things that I would have changed would have been to focus on high quality companies. I would have done my research to learn how to investigate and study these companies, to make the case to a financial advisor. No, here's why I think Apple is going to do well. And when this idiot tells me about a soda company, I can go home and I can look at the numbers and go, oh my God, this is terrible. And hey, maybe just for funsies, I can buy 100 shares or 50 shares or 10 shares, but I'm not going to put $16,000 into this thing because I know more about it. So really just trust your gut when it comes to these investments, and then research on top of that very, very heavily. Your gut can lead you to something, right? I felt Apple was a good idea. I felt a Roth IRA was a good idea. I felt that studio apartment was a good idea, but my gut also told me, trust this guy and put all your money into this soda company. So when your gut tells you something, listen and then research on top of it. Don't just rush in to do anything. The buck stops with you. You got to learn what you're doing. Trust yourself. Trust the process. Learn how to do it. Those are the things that I would do differently today. If you thought this video was helpful, please subscribe, leave a comment, share this video with your friends. Thanks for watching. Have a good day.